Good afternoon, and thank you for joining us today. My name is Frederick, and I will be your event specialist today. At this time, I would like to welcome everyone to today's web conference. All lines have been placed on mute to prevent any background noise. Please note that today's web conference is being recorded. We will have a question and answer session at the end of today's presentation. You may submit questions via the Q&A panel located on the right-hand side of your screen at any time during today's presentation. Type your question in the open area and click Send to submit. If you experience any technical difficulties during today's conference, please use the chat box on the right side of your screen to speak with me directly. You can also press *0 on your telephone keypad to be connected with an operator. The Marsh & McLennan You-Learn webinars are designed to provide you with knowledge and insights that allow you to perform your job better. Real quick, before I introduce our topic for today and our speaker, I'd like to cover two quick housekeeping items. If you'd like a copy of today's presentation, please reach out to Jennifer Brown or the MMA point of contact who invited you to attend. Today's event has been approved for HRCI and SHRM credits. We'll be providing the appropriate program at the end of today's call. Our topic for today is part of the Back to the Basics series, and we will cover how to prepare for a DOL audit. Our speaker today is Stacey Barrow. Stacey is a partner with Marathas, Barrow, and Weatherhead, and has over 15 years experience in benefits and group health practice. So without further introduction, I would like to get our session started, and we'll turn everything over to Stacey. Stacey, you may begin.
Thanks, Frederick, and good afternoon, everybody. It's Stacey Barrow here from Marathas, Barrow, and Weatherhead in Boston, and we're proud to partner with Marsh & McLennan Agency to offer today's seminar to their friends and clients. I just noticed a question came in, must I phone in to listen? I'm not sure if you can listen to the speakers or call in or not. Maybe the event host can respond to that one. But today's topic is how to prepare for a Department of Labor audit. We have a lot to cover today, so I'm going to just jump right in. And as always, if you do have questions, please feel free to type them into the question and answer box, and we'll answer them at the end. If you're looking for a copy of today's presentation, you can email Jennifer Brown or your MMA point of contact, and they will get a copy to you. So today we're going to run through what happens if the government comes knocking and trying to take a look at your health and welfare plans. So we're going to discuss which agency audits and what type of employers they audit, why and when they audit, and where and how they audit. And then the bulk of the webinar today will really be talking about what do the agencies look for upon audit. So the first part, we're really going to cover, what to do when you get that letter. And there are a number of agencies that have jurisdiction over ERISA-covered plans. You have, they call them the Big Three, DOL, IRS, and HHS. And then also you have states' attorneys general who also have enforcement over HIPAA. And we'll talk about some of the HIPAA actions in the Phase 2 audits that'll be starting this year when we get to the part on HIPAA. So in terms of who is audited, the size and the type of the employer really is irrelevant. They don't look at any particular size. We have seen audits all the way down to 10 to 15 life groups. It does happen. I would say most of them do occur in the 100-plus space, but it's not unheard of for a small group to be audited. They happen all around the country. There's no particular agency or unit that's more active than the others. The number that we always hear in terms of how many plans get audited each year are in the, quote, thousands. I think it's probably maybe around 2,000 or 3,000 ERISA-governed plans are audited each year, and then that's probably between health and welfare and retirement plans. A lot of times retirement plan audits will turn into welfare plan audits and vice versa, particularly if there are a lot of things that are uncovered that are indicative of larger issues. if you have a lot of documentation issues on the retirement plan side, it stands to reason that might be true also for the welfare plan side. We've noticed the Department of Labor ramping up their enforcement over recent years. There have been some announcement by the IRS that they're going to be increasing their enforcement activities as well. And of course, now that we have the ACA reporting and the employer mandate in full swing, we'll expect a lot of activity from the IRS in the coming years enforcing the pay-or-play mandate in the premium tax credit program. Health and Human Services also getting into the act. They have primary enforcement authority when it comes to HIPAA privacy, as well as state attorneys general. They're also getting into the fray as well. And of course, the cynical view is that the federal government needs the dollars to pay for some of these things like the premium tax credit program. And now that some of the taxes, the Cadillac tax has been delayed 2 years, medical device tax has a 1-year moratorium, health insurance industry tax has a 1-year moratorium. It's going to be all that much more important for the federal agencies to recover the dollars any way that they can, and that certainly might be through more audits. So the big question, how do plans get selected for an audit? And the answer may surprise you. It is pretty much random. Our little picture there of the lightning strike, it happens to employers all over the country, all shapes and sizes, nonprofit, for-profit, small, large, different industries. No one is really safe necessarily from getting one of these letters. They will look at all areas. Sometimes they tend to come in clusters. I remember a couple of years ago, it was really the Mid-Atlantic region seemed to be hit heavy with the audit letters. This year, I happen to have seen some more of them in the central time zone, but it really just depends, what the particular agencies are looking at. The way the process usually starts is they send a letter to the employer, and it usually has a line in it, something to the effect of, you have 10 days from the date on this letter to get us a whole bunch of documents, and there's a 5 or 6 page addendum with all these documents, and some of which you probably have never heard of, and which is okay because not every single document is applicable to every employer's type of plan. They cast a pretty wide net. They ask for things like trust documents and non-discrimination results, and those aren't applicable to every single type of plan. Hopefully, what the letter includes is an offer to avoid having the auditors come on site by providing the documents to them by mail or by email. And if the letter has that offer in it and you have all of your documents all buttoned up and everything's in a nice binder or in a nice email folder and you can zip them up, send them over, we have found that it really does tend to obviate the on-site visit. They might pick things up in the document, they might have changes they want, have issues they catch, but it's always best to avoid having them come on site if at all possible, and being responsive to their data request is one real good way to do that. So usually the letter is going to discuss what plan is going to be reviewed. If it's a retirement plan, it's typically just one plan. If it's a welfare plan, it's usually just a health plan. It could be all the plans, or if you have, say, multiple health plans, a PPO, POS, and an HMO, they might look at all 3 health plans. Usually they'll tell the sponsor that they're going to be visiting on a certain date. Hopefully they'll have that line in there about not needing to come on site if you can provide all the materials. And again, they will establish a very short time frame in which to respond. And so what we recommend is that the first thing that the client should do is engage ERISA counsel to work with them in the DOL on the client's behalf, work directly with the Department of Labor. We are in very frequent contact with them. And while the in-house counsel and your MMA benefit consultant can certainly be a huge help and be a big part of the process and help us pulling together the relevant information, we do recommend they avoid taking the lead role and going back and forth with the auditors. One thing that we're often very successful in is negotiating extensions. By the time the letter gets to us, there's often only maybe a day or two left before the deadline. We can get in touch with them very quickly, negotiate that extension, and then we can also review the documentation before it goes to the DOL so that we can find any smoking guns, hit any major issues off at the pass. And then the one of the major reasons to engage counsel directly is have that attorney-client privilege in place. You know, when you're going back and forth with your broker and you say, you know, we never executed those plan documents, we never got the flex plan in place, those emails are all non-privileged conversations. They can be discoverable. When they're had with the benefit of attorney-client privilege involved, they are not discoverable, and so it's just generally a best practice to have those conversations with your counsel. Okay, so enough about the commercial of talking to counsel when you get the audit letter. What do they audit? So these are kind of the things, the major elements that they will look for in any health and welfare plan audit. Documentation, of course, is going to be a huge issue. 5500s are a part of basically every audit that I've seen. Compliance with the electronic distribution rules are also a big focus. Document retention, the HIPAA rules. Mental health parity, also a big issue. That's kind of a pet issue of the Obama administration. They just came out a couple of weeks ago with a memorandum from the Obama administration basically putting people on notice that we do have final regulations on our Mental Health Parity and Addiction Equity Act that came into effect, I believe it was for plan years beginning on or after July 1st of 2014. So they're still relatively new, and the agencies are looking to enforce those rules. Wellness programs, also big focus of audits recently. And when I say electronic distribution rules, I'm talking about employers that, rather than printing paper copies of SPDs and all those plan documents, send them out electronically, either on the company's intranet or perhaps via email, just the electronic distribution as opposed to paper mailing. There's all kinds of rules that we'll cover when it comes to those electronic distributions. So I want to talk about what they audit, and before I kind of run through the slide, I want to make sure that we're clear on the terms. And so all welfare benefit plans that are governed by ERISA must have a plan document and a summary plan description. Sometimes these are combined into one document, sometimes they're separate. The plan document is intended to be the formal document that establishes the plan, describes eligibilities and duties and responsibilities of the participants and the plan sponsor. The SPD goes to the participants, and that also summarizes eligibility, the terms of the plan, and is supposed to be written in a clear, non-legalese fashion. And this actually, they say in the regulations, it has to be written so it's calculated to be understood by the average plan participant, and so you're supposed to eliminate technical jargon, long sentences, have a table of contents. You really want to make it clear. And so while the plan document is the legal document that governs the terms of the plan, in the event that the SPD and the plan document conflicts, a lot of times the courts will actually defer to the SPD when interpreting participants' rights. So that's kind of an important concept here. So in terms of what do they audit, they do audit the plan document. The plan document does not affirmatively get distributed to all participants, but it must be provided within 30 days of a request. Common issues we often see with respect to welfare plans might be undocumented arrangements. And sorry, I used an acronym. SPD is Summary Plan Description. Undocumented arrangements are often occur with Section 125 plans or cafeteria plans. Either they were never documented or you can't find the documents. Health reimbursement arrangements, EAPs, these are examples of some types of plans that sometimes, for whatever reason, just don't get documented. The client says, we reimburse the first half of the deductible, but we don't have a formal plan document in SPD for it. That can be a problem. For retirement plans, similar thing. They might not have all of the documents on site. You might have the adoption agreement, but you don't have the full plan document on site, and you really should have that. Bunch of information has to be included in the plan document. Plan operation details. What's the plan name? What's the plan number? Plan year? What are the benefits? What are the features? Names of the administrator. Is there a TPA processing claims? Is it self-funded? Is it fully insured? Does it use a trust? What are the claims procedures? That's a really important facet of any summary plan description, are the claims procedures. It's very important under ERISA to have ERISA-compliant claims procedures and to follow them. If a case goes to court and you can show that you followed your claims procedures, then the court will usually uphold the administrator's decision as long as it's not arbitrary or capricious. But if you haven't followed your claims procedures, then the claimant can have a de novo review where the court will actually basically re-adjudicate the claim. So it is very important to have those really strong claims procedures and make sure that your TPA, if you're self-insured, is following them. SPDs, summary plan descriptions. Those are the summaries of the plan document, essentially. You generally would provide them to employees with enrollment materials. You have 90 days to get the SPD to a new employee or a new enrollee once they become a participant. If your plan is brand new and you're just putting it into place, you have 120 days to pull together an SPD. And there are, because these apply to retirement plans as well, they have rules that might seem a little odd in the health and welfare plan context, and that's the last line here. If you haven't produced a new SPD each year, but you've been, say, amending it by summaries of material modification each year, at least every 5 years you have to redistribute a new SPD if you've made any changes to the plan in that last 5 years, and then every 10 years if there haven't been any changes to the plan. Material reductions in services also have a requirement to be, you have to inform participants within 60 days after the date of the change. And also the ACA has its own rules when you have a change that affects the content of the summary of benefits and coverage, and that occurs mid-year. That's a 60-day advance notice requirement. And just to be clear, the difference between the SPD and a summary of benefits and coverage is the SPD is long. I mean, the SPD can be 60, 80, 100 pages for a big, major medical plan. The SBC, the summary of benefits and coverage, is that 6, 7, 8-page document, the new one that's kind of newly required by healthcare reform over the last 3 or 4 years. It came into effect at the end of 2013. And that's more of like a benefits summary. The SPD is going to be much longer than the summary of benefits and coverage. So one of the issues that we often come across is whether the benefit booklets, the certificates of coverage, certificates of insurance, whatever you want to call them, the documents provided by the health insurance carriers may not completely fulfill ERISA's SPD requirements. They might get you most of the way there, but it might not include all of the ERISA rights. It might not have certain plan information that only the employer knows, like the eligibility, agent of service for legal process, the plan number, the ERISA plan year, which might be different than the contract year. Those kinds of things all have to be in the SPD, and while the carriers usually do a great job of describing the benefits, they might not always get all those little legal requirements into the benefit booklet, and that's where you have to flesh it out into more of a summary plan description. The most common way to do that is with a wrap document. Some employers, rather than sending out a new SPD each year, will inform participants of changes via a notice of or a summary of material modification. And so this is particularly useful if you don't qualify for electronic delivery. Maybe a lot of your employees are, they're blue collar, they're not using your intranet as part of their job duties, and so they require the physical copies of the documents. And so when there's a change each year, rather than reprinting that whole SPD, you can communicate the new plan changes with the open enrollment materials, and that basically suffices as your summary of material modification. There's no magic language. It doesn't have to be in any particular format. Simply by telling the employees in the open enrollment materials, this year deductible is $2,000, the copay has gone from $25 to $30, that's enough. That's telling them what the change is, and that's basically the material modification. Or, of course, you can pull together an entirely new summary plan description if you'd like. Summary of the annual report, that's something provided in connection with the Form 5500. Common issues here is that people don't always understand when the summary annual report is required. They often feel that it may not be necessary for a health plan, but the basic rule here is that if the plan is fully insured, then a Schedule A is required, and that triggers the summary annual report requirement. So, for example, for a health FSA, that's a self-insured plan. We all know what a health FSA is. There's never going to be a summary annual report requirement for a health FSA. But for fully insured medical, dental, vision, life insurance, AD&D, LTD, business travel accident, all those fully insured plans that you get the Schedule A's for, they all trigger the summary annual report requirement. 5500s, part of every audit. They're due generally by the end of the 7th month after the close of the plan year. And there was a law just passed at the end of last year, I'm just reminded of it now, that may buy you an additional month depending on the timing of your corporate tax return. So we may get a little more time on these in the future, another month or so. These are always part of every audit, and there can be major penalties when there are 5500 failures. We often recommend, well, before I get to the delinquent filer program, just as a reminder, these are the types of plans that have a 5500 requirement. They're all the regular health and welfare and ancillary plans. So health FSAs, medical, dental, vision, LTD, AD&D, group term life. These are all ERISA plans. They all have a 5500 requirement, and it gets triggered when there are 100 or more employees participating on the first day of the plan year. That's what triggers the requirement, not growing over 100 during the year. It's not 100 participants, not 100 members, family members. It's 100 or more employees in the plan on the first day of the plan year. And just to clarify, self-insured plans will have a 5,500 requirement. They usually will not have a summary annual report requirement unless they're funded through a trust. The penalties for 5,500 failures can be steep. They can be $50 per day for late filers, $300 a day for non-filers. If you come to the conclusion that you have been delinquent with your 5,500 filings, you should strongly consider the Delinquent Filer Voluntary Compliance Program. This is a way to kind of cut off your exposure to penalties and pay one pretty small consolidated penalty. When you do this, you're going to want to consider using a wrap document to wrap together all of your plans, and so that you can kind of pay one consolidated penalty. Moving on a little bit to the electronic distribution rules. We've talked about a number of the documents that are required under ERISA: SPDs, COBRA notices, summary annual reports, the WICRA notice, the Women's Health and Cancer Rights Act notice. These are often subsumed in the SPD, but they still need to be distributed. And a lot of employers would like to and prefer to send these documents electronically if at all possible. And that is generally permissible as long as employees have either affirmatively or automatically consented to electronic disclosure. And I'll get into those rules in a second, but I want to just make a point about a case that was decided within the last couple of years, and that's Raymond Thomas versus Cigna. And it just as a reminder that just meeting these requirements is not enough. You have to make sure that every time you make a new document available online, that you inform your participants that the document's out there, and so you're actually kind of delivering it to them, not just furnishing it. In the Raymond Thomas case, the company was putting the documents out on the intranet, but they weren't notifying employees that, look, a new LTD document's available, a new life insurance document's available. And so over time, as the requirements changed, the participants weren't being informed of them, and so the company ended up losing the case because they weren't being considered to have furnished the documents, or delivered them, I should say. So you can deliver documents electronically as long as certain requirements are met. So these are the basic rules. You have to be able to meet these basic rules to even get to the next step of determining which of your employees will qualify to receive documents electronically. So the steps taken for furnishing the documents must be reasonably designed to result in the actual receipt of the documents. One way to confirm this is using return receipts or notices of undelivered email features. Another way to do it is conducting periodic reviews or surveys to confirm receipt. If your IT department can tell you how many employees are actually going out on the intranet and looking at the SPD, that's a good indication. If you have 1,000 employees and 5 downloads of the SPD, you might not be clearly telling employees where to find it and how to get it, or they might have access issues, something like that. So once the basic requirements are met, there are 2 types of individuals that can receive documents electronically: those who can receive them automatically, and then those that have to actually consent. And so, like most of us on the phone today, or probably all of us, we all use email as an integral part of our job duties, and we use our employer's information technology system as an integral part of our job duties. And so folks like us, we automatically consent to electronic deliveries. And that's true even if you're maybe a traveling salesman, you have a company-issued laptop, you're obviously required to use that as part of your job duties. And so that is an example of someone who would automatically consent to electronic disclosures. One thing that you can't do, though, is to set up a kiosk in a common area for employees who really aren't using computers as an integral part of their job. That will not put you in the automatic consent category. All other types of participants, like retirees or former participants, or former employees, folks that just don't use email and computers as part of their job duties, if you want them to be able to get the ERISA requirements electronically, they have to affirmatively consent. So they need to give you their email address and then sign off and say, I have internet access at home. I have Adobe Reader. I can access the types of documents you're providing online. And so your MMA point of contact can give you a very simple consent form, and we can provide one that you can use for your employees if you'd like to have them consent to electronic disclosures. Okay, moving on. Didn't want to spend too much time on notice rules, but they are very important because if you're not following them, then it's just like you're not giving an SPD. So what about document retention? How long do we have to hold on to all of this stuff, before we can delete it? And the basic rule is that you want to maintain all of this required documents for about 6 years after the date of filing, resolution, or amendment. And so best practice there is keep it for about 7 years. So let's take a look at specifically, what are we talking about here? The original signed plan documents and amendments, any corporate resolutions you might have related to adopting the plan or amending the plan, the plan disclosures like 5500s, SPDs, SARs. A lot of claims don't come to litigation for 2, 3, 4 years after the date of service, sometimes even longer. Any trust documents if your plan has a trust, non-discrimination results if your plans are subject to those kinds of tests, and those kinds of documents. HIPAA portability, this is actually where we find the HIPAA special enrollment rights, and it's also where we find the rules for wellness programs. And that is a big focus of the Department of Labor recently. They're looking at these HIPAA issues, and when you have a wellness program that has a failure, maybe it doesn't meet the reasonable alternative standard requirements, it's actually an ERISA violation. These HIPAA portability rules are part of ERISA. Part 6 of ERISA happens to be COBRA. Part 7 of ERISA happens to be HIPAA portability. And so you want to make sure that you're giving the notice of special enrollment rights and that your wellness programs, if you have them, comply with all of the DOL rules, and I'll get into those in just a couple of minutes. In terms of HIPAA, just speaking about HIPAA, the Office of Civil Rights, which is a division of Health and Human Services, they are beginning phase 2 of their audits on covered entities and business associates. And so they're going to be doing, I think it's about 200 targeted audits around the country, probably of the larger covered entities and business associates, but it's certainly not impossible for employers to be, to receive these audit notices. And so in preparation, just make sure you do have strong HIPAA privacy policies and procedures when you're subject to HIPAA's privacy rule. So we know back in 2013, the final HIPAA omnibus rule was released. We have new breach notification requirements. That's a big part of every HIPAA audit. You want to make sure you have really good breach notification procedures in the event that you have a breach. And you know, obviously this happens all the time. We hear about it all the time. There was one, I think it was Anthem, had a gigantic breach several years ago. And employers, even those that, you know, just have a simple health FSA as their only self-insured plan, you know, we have a lot of HIPAA breach issues related to health FSAs for whatever reason. Maybe the EOBs get stuck together, but, you know, that it does happen. Payroll audits will also often look at cafeteria plans. When the IRS comes in, looks at payroll, they may look at your cafeteria plan. Plan documentation is a big issue. You know, you have to have those Section 125 plans in writing. Non-discrimination is still a big focus. We are still basically dealing with proposed regulations from the IRS on non-discrimination rules. They've been in proposed form since 2007. So, you know, anytime they're ready to give us final rules would probably be great, because there's a lot of confusion out there. But you want to make sure that in general you're not favoring your highly compensated employees with respect to the benefits available under the plan or the eligibility for those benefits. I mentioned this a little bit earlier. The final mental health parity rules have been in effect now for just about a couple of years, and there have been over the years major clarifications on the non-quantitative treatment limitations under mental health parity. And so these are the a little more nebulous kinds of limitations on a plan. It's not just, you know, the annual limits or the cost-sharing limits. These are the pre-certification type requirements, differences in network tiers, those kinds of things that are non-quantitative in nature. The regulators are looking at making sure that people who use the mental health benefits have that same continuum of care that you would get when using the medical benefits. So like when you fall and break your leg, you might get a ride to the hospital in an ambulance. You're going to get treated in the emergency room. You're going to get a cast put on. You're going to get a set of crutches. You might get some outpatient therapy. That's a whole continuum of care, and that same thing has to happen on the mental health side as well. You know, if you have a mental health episode, it might warrant inpatient treatment. It might warrant outpatient treatment. There might be an in-between where you're in a residential treatment center. You know, those are the kinds of things that we're looking for, just to make sure that the same standards are applied for medical and mental health. There's also a lot of class actions out there looking to enforce these rules. So it's not just the DOL that you need to be concerned with in terms of mental health parity issues. I think I skipped one. Let me go back. Okay. Again, wellness programs that are always reviewed as part of DOL audits. I've just repeated the rules here that are new under the ACA. The rewards must be limited to 30% of the cost of coverage. Very slight diversion. I know there are plans out there that have been promoted to employers around the country. There are wellness type of plans with the major focus is to reduce the employer's FICA obligations. We think these plans have a major issue. We strongly recommend any employer that is approached with one of these FICA reduction arrangements to talk directly to their own counsel. That can be us, that can be your own counsel, but someone that you have an attorney-client relationship with. Do not rely on any materials from the vendors when evaluating these types of plans, these FICA reduction arrangements. Sorry, I jumped. Health risk assessments, they're not usually a huge audit issue from the Department of Labor, although we do have the two regulatory agencies that butt heads a little bit here, where the Department of Labor says that mandatory health risk assessments are okay. The EEOC says they're a per se violation of the Americans with Disabilities Act. The Seth case down in Florida and the Flambeau case out in Wisconsin, both very instructive in this regard. They're both very employer friendly cases and pro-employer results, I should say. The EEOC just appealed the Flambeau case to the Court of Appeals in Wisconsin, and so it'll be interesting to see the results of that. If the appeals court finds the same way the lower court did, then we'll have two appeals courts in completely different parts of the country, both finding for the employer on this issue of the mandatory health risk assessment. So it's good news for employers. Of course, if the court goes the other way than the Florida court went, then this will be an issue that will get in front of the Supreme Court eventually. And, with its 8 members right now, who knows what kind of decision we would see. And then, of course, don't forget about the Affordable Care Act. When the DOL audits plans, any plans that claim to be grandfathered have a whole host of requirements they need to make sure they've complied with over the years since 2010, making sure that they didn't increase participant cost sharing outside of the permitted levels, and they're really looking very carefully at these grandfathered plans. As you probably can guess, none of the federal agencies are huge fans of grandfathered plans, and they look at them very closely to see if those requirements have been maintained. For all group health plans, regardless of whether you're grandfathered, or for the actually the non-grandfathered plans, they want to see the choice of primary care physician notice, compliance with preventive services, the enhanced claims and appeals provisions, making sure that your notices of adverse benefit determinations have been updated to reflect these rules. These are notices that usually come from the TPAs. They're usually pretty good about having them updated, but it never hurts to take a look at them. And other things they look at, the age 26 rule, they always want to see a list of anyone who had a retroactive termination of coverage and the reason therefore. So you'll have to make representations about whether you've ever, terminated coverage retroactively or not, and in the documents as to how you came to that conclusion. How did you determine that it was fraud or intentional misrepresentation, things like that. Sorry for the noise. We live above a fire station here in our office building. Lastly, don't forget about OSHA. There are some OSHA regulations as well that were issued in connection with the ACA. You just want to make sure you're not retaliating against employees who may try to assert their rights under the ACA. Just make sure you're informing managers, they cannot take adverse employment action against employees who may receive premium subsidies, things like that. Not too controversial. We haven't really heard of much of that happening. And then lastly, just because I've seen this come up a few times in the last couple of weeks, I think there's some webinars going on about it. This year, the marketplaces, the exchanges, are going to start sending notices to employers when they have employees who have received a premium credit. So it's kind of putting employers on notice that their employees have received premium subsidies. This is not notice of a penalty. That's going to come from the IRS, and that's going to come after the ACA reporting is done for the year. But this is basically like an advance notice saying, look, your employee has been deemed eligible. The only way that you're deemed eligible is because, they're telling us that you have not offered them affordable minimum value coverage. And so if you think that the determination of subsidy eligibility is in error, you have 90 days to appeal that. And so, some employers might say, well, I'm not going to bother appealing it, let the employee get the subsidy. But you're not doing yourself any favors or the employee any favors, because at the end of the year, when you do your ACA reporting and you report that, yes, we offered coverage to this employee and he gets his subsidy clawed back, it's going to be a nightmare for the employee. It can be very costly. These subsidies can be worth thousands of dollars. The employees are not going to be able to pay it back at the end of the year, and they're going to look to the employer for help. They're going to look to you and kind of, hold your feet to the fire a little bit. So the point is, if you feel that an employee is getting a subsidy in error because of, they've enrolled in the plan or you've offered them coverage, it's in everyone's best interest to go ahead and appeal that subsidy determination. So that brings us to the end of my prepared slides for today. I'm going to go on to the next page and go ahead and give you guys the HRCI and the SHRM credit numbers. You can go ahead and copy those down. And now I will go back and look at the questions that came in during the call. So let me go back and do that now. Some of these I answered. Here's one. Are there any issues that might apply to use of general in-house counsel versus ERISA counsel beyond just the specialized knowledge considerations? Well, I mean, that's right. I mean, your in-house counsel, probably doesn't see as many audit letters as we do and look at as many plans as an ERISA attorney does. And so, we know what to look for when reviewing the documents. We can be much more efficient with our time, so we kind of know what to look for. We speak their language. A lot of times we've dealt with the same auditors over and over, so you actually already have their numbers. Let's see. Answered that one. Does the SPD in any way govern the plan, or does the plan supersede what might be stated in the SPD, I think is what they're, yes, in the SPD. And so, I mentioned this before, the plan document is intended to be like the official legal document that governs the terms of the plan, but because the SPD is what the employee gets, when it comes down to it, if there's a discrepancy, the court will often look to the SPD to see, what the participant, would have seen and what he would have relied upon, and that's what they look to. So it's you can't always just assume that if there's a hiccup in the SPD that the plan will prevail. It's a good question. Can the SPD be provided prior to participation in the plan, for example, at new employee orientation, when the benefits don't go into effect for 60 days? Yeah, I think that's fine. Do covert participants count as terminated employees when distributing the SPDs, et cetera? Yes, I mean, they're basically treated as active employees, and so they get the same open enrollment rights as everybody else. They should get the packet. They can change plans. They get copies of the SPDs. They're basically just like everybody else for these purposes. Question on distributions. If we do a home mailing of a document, what proof would an employer need to keep to show this was done? It's a good question because it raises a couple of issues. Should you send it like return receipt? I don't think that's necessary or appropriate, really. I advise first-class mail and just make that part of your practice. And as long as you can kind of show that our policy is to mail it home first class, and this is what we do for everyone, you create a rebuttable presumption that you would have done so in this instance as well. And so it kind of puts the onus on the employee to really show that, he really didn't receive one, or, he was skipped over, something like that. So at least puts a rebuttable presumption out there. This is another question here. I've read recently that an employer's multi-employer contribution to a flex plan that includes a health plan is now insufficient for the safe harbor rules for unions and multi-employer plans. Can you comment on this, please? I'm not sure about that. I don't know exactly what you're referring to. I'm going to take a guess here. If the flex plan includes non-health benefits, then I think you're right that the employer's contribution could be in jeopardy of not being treated as a contribution to a health plan. Like, for example, if you're contributing to a multi-employer flex plan and the employees can take the money in cash or they can put it into a medical plan, then that may not be considered a health plan contribution. So if that's what you're talking about, I think it is definitely worth it for the employer to consult with their counsel that help them negotiate the collective bargaining agreement and dig into that one a little bit. What's the easiest way to prepare RAP documents? Well, not to shamelessly self-promote, but engage us. We offer a $1,500 fixed fee service to prepare standard RAP plan documents for employers. And you can get our contact info from your MMA point of contact. We're happy to help with that. Here's one that I think probably applies to a lot of folks. We received a letter from CMS regarding the data match project. Any feedback on what this is about? This is something that CMS does every year, and it is legitimate. You do have to respond to this. It's a bit technical. I don't really get involved in what the actual response looks like, but they're just trying to verify that Medicare is paying secondary when it should be and primary when it should be. But when you get newsletters, you do need to respond to it. I'm hearing that the title on the title is off on this slide here. The Back to Basics mid-year plan changes. I guess that's May's program. I'm hoping that these are the right numbers, though. The title of this one is DOL Audit Survival. Hopefully this won't cause any issues for folks. Here's a good one. Here's a loaded question. Have you heard any recent guidance regarding telemedicine programs sitting outside of the group health plan? Do they really have to be treated as a health plan under the ACA when you already offer a full health plan separately? And this is an issue that is begging for guidance from the Department of Labor and the IRS as well, frankly. I know they're aware of this. There's not a great answer. ERISA was written in 1974. We had rotary telephones then. There was no telemedicine then. But when you look at ERISA's framework, it's really hard to say that a telemedicine program, a standalone telemedicine program, is not a group health plan subject to ERISA. So, there are definite compliance concerns here. And the best advice I can give is, as an employer, when you're thinking about implementing one of these plans, talk directly to benefits counsel at some point, and we will walk you through, all of the kind of, exposure points and the different positions that you could possibly take. But we really need to do that inside of an attorney-client relationship, simply because of the lack of direct guidance out there. One little follow-up to the question about the flex plan, the person explaining that they don't allow cash, but medical, dental, disability, vision, etc. Limiting it to medical, dental, vision is fine. Medical, dental, vision, health FSA is fine. Putting in disability there is pushing it, and it's not you know, directly then an accident or health plan. I mean, maybe you get it in under the accident and health plan, you know, kind of rubric, but you know, if life insurance can be used, then I think we're starting to take it outside of a health flex contribution, and it's worth you know, taking a closer look at. Yeah, and I see the comment there about shutting it down because of shutting down the telemedicine program because of AC implications. Again, I mean, this is something you really should talk to counsel about. It is very unfortunate when the company decides that it has to take the position to terminate this benefit that's great for employees. So, you know, I really would recommend, you know, talking to your own counsel about that. Are self-funded short-term disability plans subject to ERISA? Generally, no. These are exempt payroll practices that are not subject to ERISA as long as you don't give more than 100% of pre-disability pay, you're not covering terminated employees, and your standard self-insured STD plan is not an ERISA plan. One more note about electronic delivery, more question about electronic delivery, then I'm going to conclude the call for today. And that is, what if each employee has a specific email address, but they're using a kiosk rather than a computer as an integral part of their job duties? And unfortunately, that does not work. That is still not a compliant distribution method unless the employee has affirmatively signed off and consented to the electronic distributions. And again, the program ID for these credits here on the screen, it should be how to prepare for a DLO audit. The name on this slide is just off. It's showing the next month's title. So I want to thank you all again for participating today. Look forward to talking to you all next month. If you do have further questions, please reach out to your MMA point of contact, and we're happy to help further. Have a great day, everyone.
Thank you again for joining us today. This concludes today's web conference. You may now disconnect.